है तेरी कहानी पग पग प्यारे दंगल 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 सूरज तेरा चढ़ता ढलता गर्दिश में करते हैं तारे दंगल 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 दंगल.
Great morning, my dear friends. Bhupesh Anand. I'm a chartered accountant, company secretary, cost accountant, and I did IFRS London, diploma in IFRS from ACC London. And today I will be starting with lecture number 4. And I will be discussing two learning outcomes, learning outcome number D as well as learning outcome number E. So these two learning outcomes I will be starting today. And the subject is equity and the reading is market efficiency, and we have already covered 3 lectures. Within that I have covered learning outcome A, what is the meaning of market efficiency and how it is helpful to investment practitioners. Then we have discussed what is the difference between market value and intrinsic value. In efficient markets, why they are equal, and in inefficient markets, why they are not equal. And then we have discussed what are the factors which can affect market efficiency. So these are the 3 points which we have discussed. These are the 3 learning outcomes. So today I will be starting with learning outcome number D as well as learning outcome number E. When I say learning outcome D, it is most important learning outcome of this reading. That is, what are the different forms of efficiency market? What are the different forms of inefficiency? Weak form. What is a weak form? What is semi-strong form? And what is strong form? So we will be discussing these forms and the features of these. Now this category of markets, that market as per this hypothesis, Eugene Fama, I will be telling you a person name who has invented this, that market efficiency can be divided into 3 parts. Market efficiency can be divided into 3 parts. One is weak form, second is semi-strong form, and third is strong form. So these are the 3 forms on the basis of which market efficiency has been divided, and the hypothesis was this propounded by Eugene Fama, a Nobel Prize winner. We will see who is Eugene Fama and all that. So please take out your registers. Register number, this lecture is most important because in this I will be telling you that what was there in the research paper by Eugene Fama, and then we will be discussing the different forms of market. Now before we come to that form of market, just I want to have an idea that the prices of a security are maximum, they are only affected by demand of that security and supply of that security. Now, if demand is more and supply is less, the market price will increase. Similarly, if demand minimizes and supply is same, the market price, decreases. Now, the point is, what are those factors with the help of which demand can be affected? What are those factors which can affect the demand? Why a particular security people they are motivated to buy it? Why it is so? It can be due to so many reasons. There are different reasons. Numerous lakhs of variables can be there. But the point is, in today's lecture, we will be discussing 3 or 4 major factors which will help to create a demand. That first factor is that already how much was the business? That is, what is the existing price and volume of transactions, that what is the price at which that security is being purchased and sold, and existing price, and how much is the number of units which are being traded daily. So price and volume is the most important factor which affect demand, and it indirectly affect the price. So demand is affected by thousands and lakhs of variables. So we will be discussing with 4 or 5 variables, and then we will be watching that in which form which variable works. And second, price and volume. Along with that price and volume, I can say the public information. Public information also plays a very important role in affecting the demand of a securities. For example, financials, interim financials, or there is a certain invention of gas and oil by Reliance, or different. So this information which is public, that if that is positive, it will affect demand. It will increase demand, and if this information that is public is negative, that will again affect the demand. So the point is we are discussing that price and existing volume of transactions affect the price of a security. Also the public information also, it plays a very important role. Then I am coming to private information, that information which is not public, which is private, that for example board of directors have decided to resolve, or they have resolved to come up with a right issue, or they want to declare dividend, or they want to go for bonus shares, or they want to go for stock split. That is a private information. It will take some time to become public. Now this information also affects, this can be named as insider trading. This also affects the demand of a security, and consequently it affects the price. Now along with that, I will say fundamental analysis. If I say fundamental analysis, I will be discussing in detail in the later outcomes, in the later readings. Now what is fundamental analysis? If I say Mr. Ram is healthy, he is very hard working, and he solves each and every question, practical problems of CFA curriculum. Now, in this case, I will say that there is a huge probability that he will get success in the coming examination, because he is fundamentally very strong. He is healthy. He is positive thinker. Along with that, he is doing practice daily, and he is solving the questions with the logic. And he has tried the CFA curriculum, practical problems, mock examinations, and all that. But I will say this is a fundamentally he is very strong. Similarly is the case with any security. If promoters are good, if they are doing good, if their track record is good, if I say EPS is good, their competitors, they have the less competitors, taxation policy is very favorable to them. So I will say they have a good fundamental analysis. Now fundamental analysis, it involves 3 points: economic analysis, industry analysis, and company analysis. We will be discussing in detail what is the meaning of economic analysis, industry analysis, and company analysis. But the point is, I will say the demand is affected by different reasons. One is price and volume, existing price and volume. Second is public information. Third is private information. Fourth is the fundamental analysis factors, that what are the fundamental factors in relation to that security. And the last is technical analysis. We have already discussed in economics that what is the meaning of technical analysis. When we draw head and shoulder patterns, there are different patterns for that, and when we have different, so that graph, that statistics which we are using, that is named as technical analysis. So basically, these are the 5 factors which affect the demand of a security, and with the help of which there is a change or the variation in the prices. So the point is, now we will see that if these 5 factors if they have an effect in price in markets, so we will have 3 markets as per Rugen Pharma. The first market will be named as weak form. The second market will be named as semi-strong, and the third type of market will be named as strong market. So these are the 3 types of markets which are there. Now how we will find out that this is weak, or this is semi-strong, or this is strong? So we will see these features, that if price and volume works, if fundamental analysis works, or whether public information is working, or whether private is working or not, whether technical analysis is working or not. So on the basis of these 5 factors, whether they are working or not, that we can determine that the market is weak, semi-strong, or strong. And then on the basis of that, we can have strategies, we can have 2 strategies: active strategy and passive strategy. Now in case of weak form, it is better to have active strategy, and in case of semi-strong and strong form, it is better to have passive strategy, which we have already discussed in lecture number 1, that which type of strategy should be there in the efficient market and in case of inefficient market. Because in case of semi-strong and strong market, the market information is easily absorbed in the prices. It is easily factored in the market prices. So there is no benefit in having an active strategy in these types of markets. So getting a point. So let's start with the chapter, and this is my great morning lecture number 4. we'll be discussing with learning outcome D and E, and let me show you Yugen Pharma, the person who has invented all this. That person is named as Yugen Pharma. Yugen Pharma. Pharma in Stockholm, December 2013. This person has invented, as per his research paper, as per his hypothesis, that markets can be divided into three categories. One is weak form, second is semi-strong, and third is strong form. So nationality American, he is an American. He did institution related with University of Chicago and School of Tradition and all different. He has different types of awards, even being Nobel awards are being given to him. Now, what are the inventions? Efficient market hypothesis. Efficient market hypothesis, and in that he has discussed Pharma French three-factor model. Pharma French three-factor model. The point is that we will be doing with this research paper, and also this let's see weak form, semi-strong form, and strong form of hypothesis. Now, what is weak form? When I say weak form, just have a look. We will be writing down, but still have a look. The weak form implies that market is efficient. The weak form that the market is efficient, reflecting all market information. But this hypothesis assumes that the rate of return on the market should be independent. Past rate of return have no effect. It means no effect of technical analysis. Given this assumption, rules such as one trader has to buy this is invalid. Okay, so these are the three different forms of market. So let's start with the journey, and let's write down lecture number 4, learning outcome number D plus E, contrast weak form, semi-strong form, and strong form. So the first point which we will be going to write is separate forms of market inefficiency. So there are, as per Yugen Pharma, there are 3 types of market inefficiency. One is weak form, second is semi-strong form, and third is strong form. Now this is very testable area, and I am telling you that if you will be able to write down the table which I have prepared in 3rd or 4th slide, all the questions you will be able to solve it. And in all that table you will see that what is the common point, and then we will see how to learn that with the logic. So the first point, you please write down my dear friends, please take out your registers. Separate forms of market efficiency. There are 3 separate forms of market inefficiency. One is weak form, second is semi-strong, third is strong. And the whole idea of classification, this classification into different markets being invented by Yugen Pharma through his research paper, these hypotheses. We have seen the image of Yugen Pharma. Now the most important part which I am going to tell of today's lecture is this chart, this table. Now you have to prepare this table as it is, and then I will be explaining you this table, that what is the meaning of this, what is the meaning of this, what is the meaning of this. So third point is, following is the table which shows features of 3 types of market inefficiencies. I repeat, following is the table. Following is the table. Now this is the table which summarizes all the features of 3 types of markets. So please prepare table in this form only. Have 4 columns. First column is type of market. Second is prices reflect. It means the prices which are there in the market, in the stock market, in the stock exchange, they reflect which things. Now we have discussed that 5 points are very important. Price and volume, existing price and volume, public information, private information, technical analysis, fundamental analysis. These are the 5 points we will be taking into care of while defining these markets. Second column is prices reflect. Third column is what works. What works? That in this type of market, what works and what does not work. That what does not work in these types of markets. The first form is weak form. And let me tell you that whether it is a weak form, whether it is a semi-strong form, or whether it is a strong form, existing prices and existing volume do affect, have the effect. So prices reflect. So it means the new prices are no doubt affected by existing price and existing volume, whether it is a weak form, whether it is semi-strong form, or whether it is strong form. So types of market, first is weak form, prices reflect price and volume, what works. fundamental analysis, and I have told you a brief idea about fundamental analysis. No doubt we'll be discussing in detail in coming readings. But when I say fundamental analysis, it means economic analysis, it means industry analysis, it means company analysis. So types of market: weak form, prices reflect price and volume, what works, fundamental analysis, and insider trading, weak form, because market is not absorbing all the information. So insider trading will also work, and fundamental analysis will work, and technical analysis will not work. And you will see that whether it is weak form, whether it is semi-strong form, or whether it is strong form, in all the cases technical analysis will have no role. Technical analysis will not work. So first type of market is weak form. The second type of market is semi-strong form. Semi-strong. Now existing prices and existing volume do affect this type of the new price. That is very sure. And second is the public information. Semi-strong. It means any information which has been public. Financial results are public. Interim financial reporting are public. Any decision by management is public. That is named as public, which is available to all. So it means the prices, the new prices of the securities are affected by two: existing price and volume, and public information. What works? What works? Insider trading works. Insider trading works, and what it means, even fundamental analysis does not work here. And what does not work? Technical analysis and fundamental analysis. And the last form of market is strong form. So it means the new prices are affected by price and volume of the existing. Second is public information. Third is private information. And what works? Nothing, because this form is strong form. And what does not work? Fundamental analysis will not work. Technical will not work. And even insider trading will not work. And in the last point which we are going to start with is learning outcome E, that which type of strategy we should follow in weak form, semi-strong form, and in strong form. Now I have just told you there are two types of strategies. One is active and second is passive. When we are following index, that is a passive strategy, and when we ourselves deciding that what is to be purchased, how much it is to be purchased, when it is to be purchased, that is an active strategy. You're getting my point? So learning outcome E, the implications, the implications of each form market in the strategies which we have to follow. Now there are two types of strategies. One is active strategy and second is passive strategy. When I say type of market, if it is a weak form, we have already seen that technical analysis will not work in weak, will not work in semi-strong, will not work in strong. So it means in weak form we should be active, because market prices are not reflecting the public information, or market prices are not absorbing the public information, not absorbing the private information, not absorbing the insider trading. So it is better to have an active strategy. But in case of semi-strong or in case of strong, we should always have a passive strategy. Just see to it. Please prepare a table, my dear friends. This table will help you in solving so many questions. Please don't sit idle. Please write down this in your register and please prepare a table in the same manner I have prepared. So learning outcome number E, explain the implications of each form of market efficiency and choice between active and passive portfolio management. Now type of market is weak form, semi-strong form, or strong form. What does not work? Technical analysis does not work. Technical in semi-strong, technical and fundamental does not work. And in strong, technical does not work, fundamental does not work, even insider trading does not work, because the market is strong. All the information is automatically being absorbed by the prices. So we should be having passive strategy in semi-strong and strong, and we should be having active strategy in case of weak form. So hope you have got an idea that which type of markets are there, who has invented that, what are the features of those markets, and which type of strategy we should follow in the markets. Be happy, be jolly, be cheerful.